Hey, everybody. Welcome to the morning market briefing. It's Thursday, February 26, 2026. We got a little 2026 going on. Tom, how you feel about that?
I love it.
I'll never forget the 22222 call. Never forget. Great podcast. Go back and listen. If you don't have it, Ben, how we doing?
Doing well. Ready to go.
Love it. I love it. All right, let's talk. Big earnings last night that stole the headline and was, frankly, from a market reaction, quite anticlimactic was Nvidia. Stock is basically flat. But a number of companies reporting. What are the themes you're seeing, Ben, as we think about kind of this AI-focused market and the earnings tied there too?
I think that there's a lot of work being done there. I think that Nvidia is selling a lot of chips. I think that these companies are actually figuring out a way to make money. Jensen Huang talked a lot about tokens. So for those who are unfamiliar, and that's completely fine if you are.
Yeah, put me in the token unfamiliarity camp.
A token is nothing more or less than a short string of text. Every time an AI generates something, even if it's not even the full response, it's just a short snippet of that response, that's a token. And the way these companies make money is generating tokens. And the way that they can generate the most tokens is they have the most amount of compute. But because we're power constrained at the moment, you need the people who have the most computing power are the people who have the best performance per watt, because the watt is the supply limiting factor. So basically, Jensen Huang making the point that you need the best performance per watt. That's Nvidia. So they're going to sell a lot of chips.
That's how you get a lot of tokens.
And so you get a lot of tokens. And that's really ramping up. And Anthropic's increased its revenue by 10x. They used that example last quarter as well when it was 7x. So it was a little bit of a tired example. And I think that when people are looking at Nvidia, the problem with Nvidia is that 50% of the money of the revenue generated comes from just 5 or 6 customers. And a couple of those customers are just pouring all their cash flow into Nvidia chips.
We've talked about the CapEx story and expansion. So
and another couple of those companies don't even make any money and are using Nvidia money to buy Nvidia chips. And so when you think about all of that, that's the bear case on Nvidia, that you say, well, it's great that they're doing all of this, but who's going to pay them? And maybe they'll get paid this year, but are they going to get paid next year? And so that's the concern. Meanwhile, in software did nothing to dismiss the claim that it's being disintermediated by AI. Salesforce organic growth is going to be down to 6 to 7% this year,
which is wild.
Because Salesforce, remember, they're the ones who initially said, every time someone makes a conversation with an agent, a chatbot, we're going to make $1, and that's just not working out. And
oops.
And so they're down, and I think the only reason they're down 5% this morning is because they're down 30% year to date. And then you've got other companies like Snowflake. Snowflake actually did really well. They're a data warehousing company. When you just need data, they call them data lakes, which is just a vast array of unstructured data. It's just ones and zeros hanging out there in the ether that Snowflake, holds. And
Snowflake with the legs.
Sounds valuable, I think.
And but it's just like kind of like I liken it to the if some people move and they have those storage facilities,
the pods,
the pods, or even just driving down the highway, you see all those stored, and you just pay $30 a month for a storage facility, and you dump all your stuff there that you're like, well, I might use in 25 years. I don't want to throw it away. That's kind of what Snowflake does. So Snowflake actually had a good quarter because there's a bunch of data that's just dumped in these storage facilities. But the fact of the matter is, I think that there's a lot less capital chasing these software names, and there are a lot more names out there. And so when you think of a lot of supply of these companies and less demand from investors, it's a recipe for a lower stock price. I'm not saying that there's low levels of capital around, but I'm saying the capital is flowing to other places other than software, and that's a change from what's been the case over the last 5 years.
Well, it's interesting, too, because you go back 5 years and it felt like the SaaS space was so hot, and it really got difficult. Snowflake's a perfect example. It got really difficult for me, even as a quote-unquote professional investor, to discern what does Snowflake do that someone else isn't doing. And now we're kind of seeing the market recognize that. It's like, hey, just raw data, like, who cares?
I mean, it got so bad that there was a company called C3.ai, and the ticker symbol is AI. They fired their CEO 6 months ago. The new CEO comes in and says, you know, we need massive restructuring. We need change and go to market. They're down 25% pre-market.
Oops.
So not so good there. I would also say on the healthcare side, you have ChemEd and Universal Health Systems, the hospital operator. They're both down pre-market. Both of them reported earnings, but you had some news yesterday with J.D. Vance. His first move on fraud was to go after Medicaid, Medicare, in a really diligent way, aggressive way, and that's not going to be good for a lot of these companies that are reliant on that. Whether it's ChemEd, which has home health services, I mean that's a prime area for fraud, and then Universal Health Systems, which is a hospital operator. So a lot of themes there, and just the dispersion of outcomes right now in this market is just really, really remarkable. I mean, we even talked about restaurants. Krispy Kreme, Red Robin, crushing it, both up 15%. Papa John's down 5%. And so, you know, you got to be a great operator right now, and some of these companies are, and some of these companies are not.
What are we seeing on the freight side, Ben? Because I feel like we talk. I would argue that we are the worldwide leader in daily podcast talking about freight.
There can't even be close.
There's no one else in this game.
We dominate Japanese and Swiss politics and the freight industry.
Yep, no one can touch us on that.
We did a pretty good. I would also not sell us short on the history of Korean presidents.
That's true. We did, yeah. People, notably, the most recent one just went down and is going to jail for his potential coup, which is what set off our Korean president talk the first time.
Which is a good outcome, honestly, historically. To be in jail for life as a former Korean president.
You did your job.
Yeah.
That's better than a lot of people have. Like, a lot of other guys just get killed.
I have to go back and see which episode that was, but pretty much every president in the history of Korea has gone down either by execution or being put in jail.
Yeah.
That's a job I don't want. I don't think I'm eligible at this moment.
I don't think you're cut from that jib.
No.
I don't think you could do it.
But, I mean, if we're doing the weave, we got to get back to freight, right?
Let's
at some
freight
point.
it up.
So there's a big report. There's this company outfit called Freight Waves, and they actually talk mostly about freight by land, not by sea, which, you know, might be a little bit confusing to people.
Ironic.
But they were talking about flatbed tender rejections approaching 40%. So a flatbed tender rejection is basically
everybody's talking about it.
You
Swipe left on that bid.
As a customer, you put out, hey, or basically a request for bid, but it's happening really fast. You put it out on the board, and then a freight operator, a trucker, can either take it or not take it. And what is happening is they're getting rejected now 40% of the time. So what does that indicate? It means that there's a lot of work out there that these flatbed operators don't have to take the nth amount of freight because there's plenty of work. So I thought this was very interesting. A lot of flatbed customers are in the manufacturing, the industrial space. It fits really well with the ISM manufacturing survey that we got a few weeks ago. We have another ISM manufacturing survey coming out next week. So that'll give us another update. But just kind of reading between the lines is that we're seeing more demand. I think volume's up 18%. If you look at the steel industry, steel production's up about mid-single digits year to date, maybe a little bit above that. Which is helping to increase demand. At the same time, I think that we have this narrative of the CDL drivers. I do think that the CDL issue is more allocated to dry van, which is just what it would indicate. The fully enclosed 18-wheeler that you see driving along the road. Flatbed operators they're different animals. These are guys who are rugged. They are, they have to, they got to spend a lot of time outside making sure everything is strapped correctly. They have to be much better at driving. A lot of times they carry heavier loads. So these are people that are probably a little bit more insulated from the CDL. Like if I just wanted to pick up a CDL and get some trucking work, I'd just do a dry van. It's much easier. It doesn't require a ton of expertise. So I think this is interesting to note. It also fits with some of the anecdotal data that we've seen. The reason that we're concerned about freight is and pay attention to it is because it's such a harbinger for the economy. For a long time, people talked about Dow transports. This is what we're talking about. As Dow transports go, so does GDP. As freight goes, so does GDP. So it's something that we're watching.
Tom, what are we seeing this week in bond world? It's no major headlines, but what's going on?
Not a lot. We're starting to see a little bit more chatter about potentially more cuts. I mean, we got initial jobless claims this morning. I mean, they basically were in line. I think it was 212,000. I have to look at the exact number here. Yeah, 212. Expectation was 216. So we're not seeing a lot of jobs information that's coming out that's very, I mean, it's just, there's kind of nothing going on right now in the bond world. I mean, we've stepped down. I think that's a big factor there in inflation coming down. Expectations are down. And so we've just kind of moved the entire curve down. I mean, the 30-year continues to drop, which is excellent for us. But I think there's still good opportunity there. And we talked about it yesterday. Right now, I think that continuing to increase duration going forward is probably the move. I think there's been a lot of movement. I mean, the 30 years rallied almost 5% from the highs this year, which is about a month ago. But you're still getting a lot of payment for what you're doing. You're not taking any credit risk. You're taking quite a bit of duration risk. But duration is such a lever right now. If we stumble, we see, say, hypothetically, the Dow transports continue to fall and the GDP goes down, then we're going to see rates come down in the long end fast, and we're going to see a lot of upside there. And that gives us flexibility for moving back into equities at the lows. I mean, you can even buy now, if you buy unfavorable coupons on the Treasury curve, you can get more spread. You can get a spread above Treasuries by buying Treasuries, by buying things with lower coupons. I mean, you can get almost 20 basis points of spread over Treasuries, buying Treasuries, which is something we're doing because, we've got a lot of fat coupons in portfolios. And if we buy smaller coupons with longer duration, we get more convexity, which is what you want in this scenario, and you're getting a spread. And so, we're really almost barbelling, which is buying, lower quality, higher coupon, higher yield stuff on the short end, and then lower coupon, extremely high credit quality stuff on the long end. And the result is going to be you're going to eat up that spread on the short stuff as time moves on, and you're going to have that convexity on the back end if things get a little bit wonky. And it's sort of the same playbook we've been doing for a while now. And even though rates have come down a bit, it's still pretty juicy. And then mortgages, the lower coupon stuff is starting to look pretty ripe as well. So just continuing to kind of build around the portfolios as best we can, but it's a lot like turning the Titanic because bonds move slowly.
And on the corporate side, I think it's painted with such a broad brush. Corporate credit, and I mean even stocks in general as well. But you kind of bucket a lot of these sectors together, and we were talking about it before the call about Dillard's, for example. I mean, this is a company that can really generate differentiated returns and a differentiated credit profile because of how well it's managed. And we contrast that to something like a Smucker's, who now Elliott Management is in, trying to get people on the board, and it has always been right around $100, $115 a share, even though they provide something that you think is just a really good brand value Modi staple.
Well, you know what they say about Smucker? Barely know her.
I mean, the interesting thing is Dillard's has outperformed Nvidia over the last 5 years. I mean, it's been one of the hottest stocks on the planet. The bonds are still trading like junk. Mm-hmm. So it's like this company has crushed it. They're in a better position than almost any company on the planet relative to where they were 5 years ago. The bonds still trade like they're junk bonds, and we've got tons of them all over the portfolio, and they pay almost 8% coupons, and they're very short term. I mean, that's just an easy win So saying that corporate bonds are expensive, sure, but some of them aren't.
Yeah.
And finding those correct bonds is a good play right now, kind of going against the narrative. But like the average, I mean, you want to buy an AT&T bond, you're not getting any value there, and you're also probably buying a company that's less creditworthy in the long term.
Do you want to talk super user question?
Yeah, so we got a question from a listener revolving around the Trump 401k State of the Union piece. So we did a little research on this, and it's still a little murky because, one, it has not been passed, and two, the potential rollout is 2027. But the idea is that if you are an independent contractor or self-employed or working for a company that does not offer you a 401k, the government is going to build an infrastructure that's basically modeled on the TSP, which is the Thrift Savings Plan, which is something that government workers get. It's considered one of the best-in-class retirement vehicles. They have ultra-low costs because obviously a ton of government employees, and the government's not in the business of making money off their employees in any fashion, I don't think. Ever. But the idea would be you would enroll in this. You could make contributions directly from your paycheck. It would come right out with withholdings. So you wouldn't be like a lot of murkiness where it's like, I'm getting paid, but I'm contributing to an IRA. I've got to then give that to my accountant and make sure that I hit the numbers. And then the government would match the first $1,000, which would be a massive boost. Because right now, if you're self-employed, you don't get any match whatsoever. You're capped at a certain level. So those things are still kind of up in the air. Like, could you contribute $23,500, which is now the cap for 401k, to this new self-employed TSP program? Those details are still not available, but it would be great because right now, I mean, that would basically quadruple the amount of money you could
set aside,
contribute as a self-employed person outside of something like a SEP IRA. Plus you get that extra $1,000 match. So it would be a great wealth multiplier for people who are self-employed and or not offered benefits of their job. And it's tax, the tax deductible piece of it is also very beneficial. And so that's kind of where we are right now. Whether or not that gets passed, whether it gets put through, can they get it set up? I think it would be very easy to do that at the government level. I think it'd be a big win for everybody.
Does it include part-time?
I would assume so,
presumably.
yeah. So,
yeah, I would think it would, just because I think the whole angle is people that aren't eligible for a 401k. And a lot of people that aren't eligible for a 401k are people that maybe are working at companies that offer such retirement savings, but they're not full-time, therefore not.
Yeah, so you wouldn't get it. Like when I worked at Starbucks, like you couldn't have a 401k or health benefits unless you work 20 hours a week. So like in theory, you could have this, be a part-time worker, and have some sort of retirement vehicle attached to you, which would be great.
Yeah.
But a lot of those details are still up in the air, not unlike the Trump accounts, the MAGA, I forget what MAGA stands for, but the MAGA accounts. But I think these are the things that we need to be looking at. We need to be the sneaky thing, and we talk about the difference between European stocks and U.S. stocks, is that Europe primarily works on a pension system, which is that you get a guaranteed defined benefit plan based on how much you work at your company, and then the government pays you to retire. In the U.S., the more people we can get actively participating in the market, the better our markets perform, because every 2 weeks, come hell or high water, everyone who has a 401k and is contributing to it puts money into the market. And the Europeans don't have that, and their stock prices reflect that. And not only that, we're more productive and we have better companies. And, this is a wealth creator that they don't have. Your pension is your pension. And if they decide to cut your pension because of austerity measures, because Germany's not carrying their weight or Italy's not carrying their weight in the Eurozone, then that money goes to them, unfortunately.
And also in Europe, I don't think anyone really, based on that analysis, no one has a really vested interest in their companies doing well.
Yeah, the whole idea is just to run the clock out and get your pension, and that's the game. Whereas here, it's like you want to work harder, you want to make more money, you can start maxing out your 401k, you can retire earlier, and or just be very wealthy, and that's the game. And so every time you do that, if you get kids who are unborn right now getting money from Michael Dell that goes into the market for their benefit, they will be wealthy by the time they're 30 years old in a way that people had not been before. But not only that, but the companies they've invested in will also have market cap gains over that time period because there are people actively investing on their behalf. Most people don't really get into investing until they reach a certain age. So you start dovetailing all these different things that are pushing into the economy, pushing into the stock market, getting people financially savvy about investing, we could go from being the wealthiest country on the planet by a wide margin to an untouchable margin in a very short period of time.
Hottest country.
Bang. Hottest country in the world. About to get hotter.
Love it. All right. Hot boy summer coming up. We'll wrap it up there. Y'all have a great day. Burrito time.